What are the objectives of accounting? Objectives of accounting: one, of course, to have a systematic recording of the financial transactions. Only financial transactions, only transactions which can be measured in terms of money or monetary transactions will find their place in accounting. We need a systematic recording, and that is done through accounting. It should not be in any haphazard manner. It is a systematic recording that is facilitated through accounting. We need to know the results of the business operations. We need to know profit or loss, which segments make profit, which segments are making losses, why the losses are being made, etc. So basically, accounting helps us to ascertain the results of the business operation. What is ascertaining the financial position? This is done through what is called the balance sheet. We make a statement at the end of each year stating the financial position. What is that? The balance sheet has assets on one side and it has liabilities on the other side. What are the assets and what are liabilities? Assets is what the business owns. It has land, it has building, it has machinery, it has cash, it has balance in the bank. So what the business owns, that is asset. But the business also may owe money to the banks. It has borrowed money from bank. The owner themselves, the shareholders themselves have given money to the business. So the business owes. What is it that business owes? That is a liability. The business may owe, the banks may owe other people, or may owe its own owners. What it owns, when it owes money to its own owners, it is not actually called liability. Liability to owner is often referred to as equity. The next purpose, objective of accounting would be to communicate this information. So, in case of a company form, every year, annually, the financial statements are released consisting of a profit and loss account showing the performance, the profits, the result of the business operations for that year. A balance sheet, a statement of the assets and liabilities on a particular date is released. A cash flow statement is released stating the flow of cash during the year. What cash has been generated due to the operations of the business, what cash has been used for investing, what cash is used for financing. So information needs to be communicated. Communication may be internal or may be external. Internally, the management, employees, etc. The information may be communicated to the managers, employees, etc. Those could be internal reports, and externally it needs to be communicated to potential investors, to banks and other lenders, to regulators, to the government, etc., etc., etc. Another objective of the accounting and the preparation on the financial statements is to ascertain the solvency position. Solvency position is, or the liquidity position, could be the short-term liquidity, meaning does the business have cash short-term, or the long-term solvency position, or the long-term liquidity position. It could happen that a business makes profit, but its short-term liquidity position, it does not have enough cash to meet its day-to-day operations. So, with accounting, better control can be exercised since solvency position, etc. can be quickly identified when there is a proper system of accounting in place. This in brief would be the broad objectives of accounting.